everyone. It's my great pleasure to be here today to discuss with you my perspective on one of my favorite topic, the impact of big data and technology on insurance, and more specifically on underwriting. But before I start, I would like to invite you to warm up a little bit. I have 3 questions for you. Let's try. Okay, the first question is easy. In 2009, Uber received the first seed funding of $200,000 US. How much is Uber estimated valuation today? This one is easy. Yes, you're right. So the answer is D. Let's try the second one, which is a little bit tougher. In the first half of 2016, the investment in InsurTech is $1 billion, which is how many times than what it was in 2010? It's C. Right. Last one. This is interesting. How many innovation labs and centers have been set up in Singapore over the last 24 months? Almost right. So I think it's more than 18 according to what I know. Okay, so let's go to the main content. As we know, as a result of mass digitization, more and more data is captured, stored, and analyzed. And usually we think of data from internet, social media, phones. But it does not stop there. With new technology, devices that store and communicate data becomes cheaper, smaller, and more powerful. So a tiny sensor nowadays costs around $1, which is very affordable. So as it's increasingly affordable, we could imagine a day when everyday objects surrounding us is equipped with sensors, and it leads to the concept of the Internet of Things. So the Internet of Things clearly accelerating the amount of data generated. Furthermore, the advanced analytic technology also empowering us to be able to mine, visualize, and model data. And all of that have significant impact on underwriting. So frankly speaking, I think we're still in the early phase of the wave. However, I think the trend is unstoppable because it's not created by one single force. It's driven, of course, aggressively, first of all, by technology, but also by consumers and governments. So we can see that technology is shaping the consumer behavior and demand significantly. One prominent example is, do you think what people do nowadays before their meals? What do? They selfie, and they post to Facebook. So similarly, when disaster happens, people also tweet and share information on social media. So what they share help insurers to understand the customer better, the risk better, the situation better. On the other hand, consumer demands on how insurers serve them and interact, engage with them are also totally different from the past. So this slide is just to illustrate how much data generated on the web every second. And as a consumer change, the governments have no choices but to adapt. So in fact, some governments are quite visionary with their smart cities initiative. And remember, the fundamentals of smart cities is data, connectivity, and intelligence. So while those changes create, of course, a lot of data for insurers, and disruption, threats, and opportunities. So one recent report from the World Economic Forum mentioned that the most imminent effects of disruption will be felt in the banking sector. However, the greatest impact of disruption is likely to be felt in the insurance sector. I think APEC will not escape this tsunami. And in fact, we see a lot of happenings in this region recently. One clear example is on the smart cities initiatives. 22 out of 30 major smart cities across the globe will be here by the year 2022. And this slide just lists a few examples of smart city initiatives in this region. We believe that APAC is the opportunity land for big data because it's a hotbed of digital adoption. Consumers in this region are very eager to try new solutions. Also, by 2020, 1/3 of connected things, or 1/3 of the data generated by the IoT globally will be here. Last but not least, the chronic huge protection gap in this region is in dire need for innovative solutions. So, with all that, we believe that technology advance and big data is transforming the way insurance is underwritten, sold, and engaged. So first of all, technology is changing the risk landscape. And the changing risk landscape will require insurers to adapt their underwriting capabilities. How will the risk landscape change? First of all, some risks will change hands. For example, the case of driverless cars. So car insurance may become product liability of car manufacturers. Secondly, new risk pools will emerge. For example, the case of 3D printed body and tissue and organs. Thirdly, some risks will shrink thanks to better mitigation and prevention. For example, the advance in biomedical technology and behavior change via wearables and the quantified self. All that are believed to be the major forces that shape the future mortality. And last but not least, some existing risks may evolve and become more extreme. For example, cyber risk or accumulation risk for supply chain. So to stay competitive and to stay relevant, insurers have no choice but to improve their understanding of the changing risk landscape. And new data source will be their weapons. New data sources will help insurers to revolutionize underwriting. So instead of relying primarily on historical data and assume that the future will merely be repetition of the past, insurers now will be able to build new models, allowing for prediction of losses based on completely novel data. This data fingerprints the risk of individuals, buildings, business. And this data is very different from the typical data that insurers usually use because it's about real behavior collected in real time. So some insurers will definitely be at the frontier of this trend, and they will be able to build more accurate risk models. They will use this competitive edge to pass the bad risk to their competitors and to the capital market. So I will cite a lot of examples here, what kind of data sources are used for different lines of business. But majority of my examples today would be around sensor data, telematics data. When we talk about telematics data, it's not just about car telematics. It's also not just about wearables for life and health. It's also sensor data that is applicable for commercialized, for example, marine or netcat or agriculture. So let's go a little bit deep into car telematics. The traditional underwriting factors for car insurance is usually basic demographic information of drivers, like age, gender, or some information about vehicles, like make, model, but it's not real time. It tells you nothing about the actual driving behavior. Telematics data now can tell us a much better, more accurate information about driving behavior in real time, almost real time. So for example, the GPS and sensor data can tell us about the frequency and the magnitude of the heartbreaking or acceleration events. And when combining with contextual data, we can know whether such behavior is risky or not. For example, speed in relative to road condition, weather condition, traffic condition, etc. All these new factors can be input to the scoring model, and the output of a scoring model could be used as proxies for pricing and discount. And of course, the scoring model could be further improved by cross-validation against claims data. Agriculture. This is also one of the topics that I invest a lot of time to study. Administering crop insurance in Asia with lots of small fragmented agricultural land holdings is expensive. We can reduce the cost with index-based or parametric insurance schemes. However, the existing parametric insurance is usually deal with very high level and generic data, which tell us nothing about the actual experience and the actual risk at the farm levels. For example, weather information, because it's index-based, so usually it's about the weather information about city, but not the micro weather information of a village or a farm. And you know that the water level or the rain level and the flood risk for a farm at the bottom of the hill is totally different from the farm at the top of the hill. So with IoT, with sensors, big data, we're now able to collect more granular data at individual farm levels. For example, micro-weather data. For example, soil condition, moisture. This information can be collected from satellite images, drones, and ground sensors. And these new data sources definitely will help insurers to innovate the products and underwriting for crop insurance. Natural catastrophe. Big data can bring catastrophe modeling to the next level. So what is the current status quo? We know that not all perils are modeled. In fact, non-model perils accounted for 30% of claims. And also, existing CAT modeling could not refresh easily. It's very tough to refresh a model. I mean, maybe the maximum we can do is once a year. And of course, it's not synced to any real-time information. So availability of new data sources and advanced modeling techniques could provide new insights and transform the CAT modeling. And I have some examples of new data sources that could be useful for NatCat modeling. Locational data. So such location insights could be very valuable for insurers because now we can find out the exact number of affected people during an extreme event, or we can predict the risk of a location at a time by observing the number of people visiting that place. Sensors, camera, drones data is also give you similar insights, which is very useful for disaster modeling. For drones, recently, I think you know that AIJ announced that it is going to experiment with drones to conduct inspection for risk assessment, risk management, and loss control. Thirdly, the GIS satellite images. Again, this data source is extremely useful for risk modeling. For all kinds of disaster, from tsunami, volcano, earthquake, forest fires. For example, thermal sensor can spot active fires, infrared sensor can pick up floods, and microwave sensors can be used to measure earth deformation before and during earthquake. In Swiss Re, we have a solution called Swiss Re CatNet solution, which is free for our clients, and it combines the natural hazard information with Google Maps and satellite image. And last but not least, social media information, definitely a proven data source that could be very helpful for epidemics and disasters tracking and prediction. Some examples is, of course, you know, the incidents of Haiti in 2010 or the Philippines typhoon 2013, where social media has been used for tracking and mitigating the risks. Okay, another example is in marine. So similar to all the examples that I have mentioned, the Internet of Things at sea could improve risk understanding and loss prevention for marine insurance. I have a few examples here in the few boxes. So, for example, all international ships of more than 300 tons and all passenger vessels in respective of size are mandated to carry a transponder that broadcasts their position, speed, and course. It's an anti-collision system, and it's called AIS, Automated Identification System. So AIS transponder data is very interesting, just like car telematics, because it helps insurers to improve their trade flow assumption for accumulation model at ports, and also help insurers to improve their collision models. Beyond AIS data, we're also looking at satellite data. So satellite data from vendors such as piracy maps, vessel density map, oil floating map, sea state map, storm map, etc., could also help insurers to understand better risks, even beyond ports, the real risk on sea. And therefore, shipping routes could possibly become a new rating factor, just like driving behavior for cars. And last but not least, another example is onboard sensor data for diagnosis and prediction could also be used for furthering risk. So I have presented to you a couple examples on P&C, and I have more for life and health. I think the impact on life and health is even greater, especially for underwriting, because it allows more real-time, personalized, faster, more accurate, and transparent underwriting. So the first thing that I would like to mention is wearables. So wearables can tell us fitness lifestyle of end consumers. Some devices could also track health-related information, for example, blood pressure, blood glucose, or even brain health. Secondly, genomics. So genomics itself is a big data problem. And solving this big data problem to identify which gene mutation are associated with which disease will revolutionize underwriting. This slide showing you that the cost of DNA sequencing is dropping dramatically over time. And I think the cost nowadays is less than $1,000 US. Data also comes from platforms. We see the rise of platform economies, and platforms are indeed rich data sources. So for example, the platform Patients Like Me in the US, where patients share their experience with drugs and other treatments in order to help themselves, people like them, or organizations that focus on their condition. So I have been talking about wearables, genomics. Then we also have smart hospitals. All these are rich data sources in order to understand health risks. And we can even expand further to build a correlation with other data sources at home from smart home devices or with the environment, for example, weather information. And then suddenly it can tell us a lot about health risks. So this massive amount of data that is available, and especially is unstructured. So I think you have to agree with me that it's not easy. It's not easy to derive insights from big data. But luckily, I think with technology advances, it makes the mission possible because we see the rise in the number of tools available for mining, text mining, voice mining, for modeling, like machine learning, AI, cognitive computing. And all of this will enable innovation in underwriting. And for underwriting, usually we thought about a few key concepts that I list here. Predictive underwriting, automated underwriting, dynamic underwriting, GBI underwriting, and evidence-based underwriting. So, for example, in evidence-based underwriting is nothing new. It has been in insurance for decades. What is new here is the new data sources. What is new here is that searching medical database on global scale and regular assessment to new data sources become more feasible nowadays. And current best evidence is also become easier to obtain than ever with access to electronic medical database from a lot of different third-party providers. So capitalizing on this, a few large reinsurers have developed automated system for evidence collection and analysis. I have also another example on predictive underwriting, but because I only have 2 minutes left, so I need to quit this. But predictive underwriting is also an area that insurers are paying attention to. Predictive underwriting will lead to automated underwriting because now you have rules to automate. Automated underwriting will help to reduce one of the major obstacles that insurers are facing in order to engage and reach consumers. That is the lengthy, complex, and invasive underwriting process. This example is to show you Swiss Re Magnum, also a solution at Swiss Re that allow automated underwriting for life and health. Okay, so we go to AI. Automated system, automated underwriting will be brought to the next level with AI and machine learning. So AI system can learn from large set of data and apply that knowledge to the future situation. For example, it can link and learn from different types of unstructured data sources from wearables, EMRs, claim history, to build complicated risk models, which can be refreshed easily, which can be self-improved because machine learning allows such system to learn from different data inputs, which is totally different from the traditional rule-based models. Okay, so I think it's still a long way for insurers to totally capitalize the full AI capabilities. In the meanwhile, I think insurers will likely use a combination of cognitive and rule-based logic in order to streamline their underwriting process. So I have presented to you a lot of benefits, a lot of impacts on underwriting. But I think one final benefits that I want to highlight is that technology and big data will allow insurers to insure the uninsurable. And I'm saying about diabetes, cancer, cardiovascular disease, because now insurers suddenly have new information about behavior. And it could use behavior as a new dimension for their pricing models. So I have one last minute. Just want to summarize to you what I see, what is happening in the insurance industry. So first of all, I think you all agree that startups are invading insurance tech. These are all the numbers to prove. Multiple tech giants have moved into insurance. Probably recently you read news about Google. We talk about Zhong'an, which is investment of Tencent, Alibaba. So what insurers are doing? They increase spending on evolutionary innovation across all the cycles between pricing, actually claims, and etc. And some players have made bold steps. So they set up labs, they set up corporate ventures, they have startup deals, they build partnership with university research institutions, with governments, etc. But I think, looking at this current situation, I think you have to agree with me to be practical that this is not easy. It's not a rosy road. It's a bumpy road. And I just want to cite one of the statements by CEO FitSense. So FitSense is a startup based in Singapore, which aggregate data from various wearable devices and provide insurers with scoring model, health scores. And they've been struggling when they talk to a couple of insurers. And this is what they say, that most of the companies we talk are not yet ready for this. And then therefore, they have to change their proposition from providing a scoring model to be engagement. The willingness to be the first mover in this industry at this current stage is still low. So I think my conclusion for this topic is I strongly believe that this insurance industry is in ripe for disruption. The traditional business model is in jeopardy, but whether are insurers ready to rise the occasion? So I would urge the technology solution providers, the startups, to help insurers to get ready. And I also wish the best luck to all of us on this road, especially to startups who is shaking the status quo, and especially to our colleagues in the innovation labs who are building the bridge. So that's all for me. Thank you.
Thank you, Sophia. Time for a quick question for Sophia, if anyone has a question in particular that's burning at the moment. Here we are. The microphone, please.
Thank you. Very interesting. I just wanted to pick up your brain on something, on how some of these technologies could apply to the low-income segment. So if we take some example of what you say, that, for example, I think agriculture, for example, health tech, it could really have an impact on these people, right? The only problem so far is that so if we take the example of health tech, the unit variable cost of these devices is very high, which makes it unaffordable for them. Or if we take the example of crop or livestock insurance, the fixed implementation cost is extremely high. For these guys to understand it, it's very hard as well. So, which makes in the end, again, unaffordable and inaccessible. So, what do you think about that?
I think it's a good question, and I don't have a universal answer for all lines of business, because for life and health is different from agriculture. But I think in general, it could happen in three ways. The first way is it improves accessibility. For example, with microinsurance that is distributed through prepaid phone cards to rural people in India, for example. So accessibility. The second is on the pricing, because we're talking about tiny, on-time, on-demand products. So there is a probability that the price could be reduced. So for example, I will only insure flood when there is a very high, for 3 days instead of for the whole year, when the probability of flood is likely to happen. I mean, just an example. And the third way, I think, is allows insurers to innovate different product coverage that is suitable for different segments. So nowadays we see, like, for example, Slice startup that is shown. It's a different business model that give insurers different kind of products. Because usually the traditional products is like annual, is index-based. So with new technology and big data, it allows for product innovation. Yeah, thanks.
Thank you. Just one more here. That maybe have to be later, Woody. You got that microphone?
So I'm very curious, as we deal with regulators around the region, how has been the interactions and the reception of like dynamic or even AI-based underwriting models? Because the regulator usually asks that, do you have historic information for this particular thing? And some of them tend to be quite anti sort of short-term policies, for example, in life. So these are, I think, interesting struggles. It'd be interesting what you've experienced so far.
Sure. So I experience differently between commercial lines and life and health side, of course. So I think it's easier for car insurance or for agriculture insurance, but it's a little bit more difficult for life and health because we need to deal with very, very sensitive data. So I think for car insurance, for agriculture insurance, definitely it will go ahead very fast. But for life and health, I think the whole legal and compliance is a thing that we need to look at. Yeah.
Go on then, Woody. One more.
Woody Moore from eBaotech. Since you talk about pricing, underwriting, okay. A very important question for this industry is the industry ready to give that so-called secret sauce out to third-party platforms, right? So we are actually doing a lot of these kind of things as a bridge between insurance and innovators. Companies like Zhong'an is our actually customer using our platform. But one of the key things is that insurance companies need to be ready to provide the underwriting rules, pricing, to give us to the platform. I mean, in China, a lot of local companies are very open because they gain speed. They trade speed versus the so-called control, right? But in Southeast Asia, we see much more conservative attitude to say, I give you the rating algorithm and the underwriting rules. So because we believe that if that does not change, we still have to integrate to the core system of the insurance industry. Inevitably, that is going to be extremely slow. So as we build a lot of APIs, we have the technology, but we still need the content so since you deal with a lot of insurance companies, what's your assessment about that attitude?
I think it's changing. The problem you're facing is because nowadays a lot of underwriting still not automated. So they are scared to give you all the rules.
But they don't have any rules, actually.
But I mean, it makes sense that they have like maybe 10 rules in their book and cannot give you all, right? But now we talk about automated underwriting, which will allow them to give you a black box, so they will not be scared. But of course, automation of underwriting takes time. All of the concept that we're saying, I know a couple of insurers are piloting, but they need more time. Yeah.
Okay, thank you very much, Sophia. Thank you.